Would you like to learn the trading strategies of billionaire trader TOBY CRABEL? Probably, right? Myself included. He wrote what is now a very rare and expensive book titled Day Trading with Short-Term Price Patterns and Opening Range Breakout. Now, you may have heard of opening range breakouts, and he is the grandfather of them. Now, you can get the book off of Amazon used copies, but they're currently going for around about £1,600. Why are they going for £1,600? Because when Toby published the book in 1990, he then went, I don't want anyone else to know about these strategies, so he started buying up all available copies of the book. So the book is now extremely rare. So sure, you could go to Amazon, spend 1,600 quid buying the book, or you could just watch this video where I'm going to explain to you his trading strategies. MarketSmith are today's video sponsor. If you're interested in a discounted trial, there is a link in the comment section below. And for all of that being said, let's go gadget. So these are the key concepts, and the first one is the core principle. So that is the principle of contraction and expansion. Now, this ain't going to make any sense to you right now. I would recommend watching this video 2 times like with all the videos, because there's a lot of information that's going to come at you, and it's going to come very fast because I talk fast. That's the ADHD, that's the dyslexia. My brain goes at 1,000,000 miles an hour. So these are the core principles, key concepts. Principle of contraction and expansion, repeatable patterns, NR4s, NR7s, 3-bar NRs, 2-bar NRs. Don't worry, you're going to learn about them all. Opening range breakout, narrow ranges, and inside days. And we've got lots of charts to explain this as we go along. And then at the end of the video, I'm going to show you how I apply this to my own trading. And then to finish, I'm going to show you how to quickly screen for stocks, potentially setting up these patterns. So what are some of the main patterns? Now, ignore WS4 and WF7 because you're going to see some data on the next slide, which is going to explain to you why. Focus on narrow ranges. So NR4 is the narrowest daily range relative to the previous 3 days daily ranges compared individually, and NR7 is a day with a daily range that is narrower than the previous 6 days daily ranges compared individually. Widespread 4 and widespread 7, you can read those for yourself. As I said, ignore those basically. Focus on the narrow ranges, as you're going to see why in a couple of slides time. So this is what an NR4 looks like. Don't worry, lots and lots of examples as we go through. NR7, this is basically what it looks like, and don't worry about trying to understand the stretch. I'm going to teach you how to calculate that in a few more slides. So here we go. A little bit text heavy, but important to get the data behind it. So when Toby tested these are the key findings. A cumulative total of gross profits for the contraction patterns versus expansion patterns on trades in the direction of the move off the open that showed $710,000 for contractions on 7,313 trades and $102,000 profit for expansions on 7,524 trades. What on earth does all that mean? Well, this is the important part. Profits were 7 times larger for opening range breakout, so that's ORB trades, after contractions than expansions. So remember on the previous slide, I said ignore those WS, those widespread patterns, and focus on the NRs, focus on the narrow ranges. This is why, this is what the data is telling us. Clearly, something is going on here. This suggests, I should say, from these results, is that one should be looking to go with a forceful move off the open after a contraction and not willing to do so after an expansion. If nothing else, one should be aware of the dangers of ORB trades a day after a big directional day. I know I'm just paraphrasing some of these key points. This is when most attention is given to the market by novice traders who invariably get caught in whipsaws and trendless markets. So let's talk about the core principle of contraction and expansion. Now, you will also probably have read some other very well-known trading books, such as Minervini's Volatility Contraction Pattern, and as the name implies, volatility, contraction. So what you tend to see now, Toby was a commodity trader, was commonly, that was a cross between commonly and commodity, was a commodities based trader primarily. But this principle, and I'm going to show you charts from over 100 years ago to illustrate these patterns across multiple different time frames as we get later on in the presentation. But this, you will notice this contraction and expansion principle in commodity markets, in the S&P, in the triple Qs, in individual stocks, in cryptocurrencies. You will see that the market tends to, and prices tend to contract and then expand. So what his data was really looking for, and what he was trying to do is, okay, before that expansion in price, what tends to happen before it? is expansion met with expansion before that, or is it actually contraction that happens before the expansion? So let's dive into it. The contraction expansion principle states that the market is constantly changing from a period of movement to a period of rest and back to a period of movement. This interchange between the phases of motion and rest is constantly taking place, and you'll see this across all time frames. It would seem that one phase is directly responsible for the other's existence, but has not been proven in the general case. The evidence in this book suggests strongly that this principle applies to the particular case of price action off the open. There is an explicit proof for this in the book. The principle of contraction expansion is defined as the market phenomenon of change from a period of rest to a period of movement back to a period of rest. The interaction between the phases of motion and rest are constantly taking place, with one phase directly responsible for the other's existence. I know I repeated myself there, but it's really, really important. If you think about Newtonian physics and what Isaac Newton said, an object at rest stays at rest and an object in motion stays in motion with the same speed and in the same direction unless acted upon by an unbalanced force. And you're going to see a little bit later that Toby studied the works of Richard Wyckoff, who had a massive impact on my own trading as well. So a study of price and volume is a study of force between supply and demand. And you're going to see that Toby doesn't just come at this from kind of a data analytical standpoint and kind of quantitative, actually looking at the charts, looking at trend lines, looking at support and resistance levels, which I really, really like. So this is just a visual illustration of the contraction expansion principle. You can see that on here we've got bars, so the open, high and low close is shown, and you can see that there are contractions, so there are bars that are tight on a relative basis, and you can see that there are expansion bars as well. So this is a kind of like a copy. I obviously did this myself here, but this is what it looks like from the book when Toby is talking about contraction and expansion. Hopefully you all know what a bar looks like. Basically you have the low, you have the high, you have the open, and you have the close. Nice and straightforward. Right, next slide. So opening range breakout. What on earth is an opening range breakout, an ORB? So here we go. An opening range breakout, hereafter called ORB, is a trade taken at a predetermined amount above or below the opening range, called the stretch, which we're going to get into. When the predetermined amount, the stretch, is computed, a buy stop is placed that amount above the high of the opening range, and a sell stop is placed the same amount below the low of the opening range. The first stop that is traded is the position, and the other stop is used as a protective stop. The stretch is determined by looking at the previous 10 days and averaging the sum of the differences between the open for each day and the closest extreme to the open on each day. So that is looking using the high and the low relative to the open and taking the lowest amount. I'll explain it on the next slide. The ORB is effective after inside days that have a smaller daily range than the previous 4 or 5 days, and for that matter after any day that has a daily range less than the previous 6 days, NR7, whether an inside day or not. The ORB can be utilized as a general indicator of bias every day. Whichever side of the stretch is traded first will indicate bias in that direction for the next 2 to 3 hours of the session. If nothing else, this information alone will help keep you out of trouble. So I then apply this in my own trading on higher timeframes. I'm looking at lower timeframes. I use multiple timeframe analysis, but I am primarily looking at the weekly chart, the daily chart, and the hourly chart. But you will see these patterns across all timeframes, from the 1 minute chart to the monthly chart. So this is the stretch. So the stretch to determine the ORB or the ORBP, as you're going to learn in a few slides times, entry levels. So stretch is defined by looking at the previous 10 days and averaging the sum of the differences between the open for each day and the closest extreme, high or low, to the open. So if we were to look at here, day one, I haven't done all 10 days because hopefully with 3 examples you'll get it, and then we'll work through this over here. So day one, imagine that the open is at $97, the high of the day is 100, and the low of the day is 96. Therefore you would take the figure 1 for that day. On day 2, the open is at 99, the high is 104, and the low is 91. So which is smaller, from the open to the high or the open to the low? So from the open to the high, that's $5, whereas the open to the low is greater than that, so we take the $5. So we've got 1, we've got $5. This is a pretty volatile instrument that we're looking at here. Day 3, we've got the open at $97, we've got the low at $94, and the high at 103. So the distance from the open to the high is $6, the distance from the open to the low is $3, so we take the $3 figure. So here is what it would then look like to calculate the stretch. Now this is going to be if this was a stock, it would be a fairly volatile stock, okay? But just, you can work this for yourself. For the sake of brevity, I won't read them all out to you, but you can see how you get your total here. So you add them all up, divide them by 10, and then $1.40 in this instance here would be the stretch. So imagine if you get this NR7 setting up, you get this tight bar here, it's an inside bar here, so then it will be $1.40 is the stretch that you're using as the predetermined amount I just explained on the previous slide. So here you can also have the opening range breakout preference, known as the ORBP. There are days when a trade in only one direction is taken. This is called an opening range breakout preference, ORBP. Usually this is done in a market with strong bias in one direction or just after a clear supply or demand indication. The procedure is similar to the ORB, but the only order entered is the stop in the direction of the entry. The protective stop is entered only after the trade has been entered. One qualification to this is if the market trades to the stretch in the opposite direction first, the ORBP, so the order is then nullified and the resting order is cancelled. This requires you to monitor the market during the session. Intraday market monitoring is not a sacrifice by any means and serves to enhance the system in most cases. The ORBP provides an effective trade entry at times of a clear bias in one direction. Talk about this in a minute. In particular, a running trending market, when defined, provides a very clear bias. On any inside day, the ORBP should be taken. Inside days act as the springboard for an immediate continuation in the direction of the run. So what I've done here is just given you two examples. Both of these, you could be thinking they are NR7s. They could also be, as you're going to learn in a little while, they could also be 3-bar NRs as well, but you're going to learn about that. So imagine here, the only difference basically is that you've got the 21-day EMA for the top one, where price has been butting into it, so it can't break it. The 21-day EMA is acting as resistance. Imagine this is a daily chart. So here you could be thinking, well, it could act, you've got this tight little range here. So actually what I'm looking to do is short it because the stock is now in an intermediate term downtrend. However, on the bottom one here, you've got your 21-day EMA. You've had a nice shakeout here, a nice shakeout here, a nice shakeout here, then supportive action. Then you're starting to get the tightness coming through. This, just looking at the 21-day, would actually indicate the stock is in an uptrend. So the underlying trend, the primary trend, which Toby gives the greatest consideration to, is in the context of an uptrend. So the bottom one, your ORBP, so your preference would probably be a long trade, whereas the bottom one, it might be a short sale. Okay, so that is how you could have a preference going into the session. Okay, this session here, if this stock moves to this predetermined amount, that's where I'm going to go short, and I'm not considering it as a long. On the bottom one here, it'd be the opposite. If the stock moves to this, or this whatever instrument it is that you are looking at, if it moves to this predetermined amount, I'm looking to go long, but I have no interest in shorting it. Makes sense? So that's the opening range breakout preference, but it really brings into the technical context of whatever instrument. I'm just going to refer to it as stock. Whatever stock you are looking at, you think, okay, powerful stock, relative strength is really good. Maybe there's 52-week highs coming through, triple-digit earnings, triple-digit sales, all of that good stuff. This is one that I'm looking to go long. I'm not looking to go short it, and vice versa. So a little bit tech savvy the next two slides, so bear with me. So entry period and early trade management. So this is specifically talking about, okay, when there has been an opening range breakout, what are some of the things that you want to see happen very shortly after the entry? So on the entry and very shortly after the entry. So this is about understanding what is optimal behavior and what is not optimal behavior. So in general, the earlier in the session the entry is taken, the better the chance for success. In fact, the ideal is an entry within the first 10 minutes of the session. In that case, an immediate continuation in the direction of the breakout is likely. When you get action like that, the protective stop can be moved to break even very quickly and the trade is free. You would have heard me speak a lot in recent videos about risk mitigation and free rolling as I punch the microphone. It's really important. The more time that passes between the open and the trade entry, the lower the probability of success. Adjust the size of your position downward as the day goes on, and there's no reference to position sizing within the book. So this is obviously, you have to use your own kind of rules in determining position size. The worst entry is just before the close when time is running out and it is difficult to realize a profit. Remember, Tony is more focused on day trading, much shorter term trading instead of intermediate term trading. It should be kept in mind that the objective of these entry techniques is to establish a position for a 2 to 3 day run, but this can be considered only if a substantial profit is realized by the end of the session. After the trade is entered, the clock starts clock's ticking. The ideal trade will show a profit almost instantaneously. So it will just power out. The opening range breakout gets triggered and it will just power out or power down if you're going short, and you'll have a trade that is profitable immediately. The longer it takes to move away from the point of entry, the more vulnerable the position. In general, stops should be moved to break even within 1 hour after entry. So remember about free rolling, about risk mitigation. You can see Toby talking about it in the book. Absolutely love this book. A market that displays greater tendency to trend should be given less than an hour. For example, the S&P usually takes no more than 5 to 10 minutes before a clear gateway occurs in terms of a trend. When judging the market action after entry, compare it to the ideal early entry EE with immediate profit and persistent follow through thereafter. Action which varies from the ideal is suspect. So ideally, imagine if you're going long, and let's say you're going long a stock and you're buying it here through the high of, I call them trigger bars as well, but through the high of say an NR4 or an NR7 or through the high of a pivot, you just want to see it go and go immediately and show you a profit very soon after your entry. If it doesn't, what Tony's saying there, action varies from the ideal is suspect. In summary, the open is a market primary. Without an understanding of its importance and the market action around it, it is difficult to come to correct conclusions about market direction. On certain days, it acts as an ideal point of entry upon breakout. On any day that such a breakout occurs within the first 10 minutes of trade, the information is overwhelmingly in favor of a continuation of that move. If one does not use these entry techniques systematically, he should at least utilize them as a general indicator of bias. Here's another one. So opening range ORB early entry. So early entry EE is defined, this is the last text heavy slide you'll be happy to hear. So early entry EE is defined as a large price movement in one direction within the first 5 minutes after the open of the daily session. This is the ideal price action when using an ORB for entry. A study of EE is essentially a study of price action. I have observed two types of EE, early entry. The characteristics of a type 1 EE are as follows. The first 5-minute unit has a larger range than normal. Norm is roughly defined as the average of the preceding 10 days' first 5-minute range. Open of the day is on one extreme of the 5-minute bar, and the close of the 5-minute bar is on the opposite extreme. So basically a widespread candlestick bar. The open, if you're going long, is near the low of the bar, and the close is near the high of the bar, and then it would be vice versa for a short. The open is on the high of the bar and the close on the low of the bar. The second 5 minutes shows an equal thrust in the direction of the first 5-minute period. A type 2 EE is extremely powerful and is characterized by an excessively large range in the first 5 minutes, quite possibly bigger than the previous 20 days first 5-minute periods. An equal thrust in the next period is difficult to manage, but a general drift in the direction of the first 5 minutes is likely with an acceleration after further accumulation has occurred. There's so many Wyckoff phrases and terminology, really like it. One possible application is as follows. Use an ORB entry technique each day anticipating an early entry. If ideal action does not occur within the first 5 to 10 minutes, cancel orders. An open outside the previous day's high or low sets up an intraday up thrust or spring, more Wyckoff terminology. Computer tests show that on a move back into the previous day's range of 2 ticks, the market has a 67% chance of closing beyond that point. This is excellent advanced information when it coordinates with an early entry extreme. It has implications for the entire day's trade and quite possibly the next several days' trade if a reversal pattern forms on the daily chart. The most important types of price action have been described already and occur in the first 5 to 10 minutes of trade, but there are times when even with a defined thrust the price will not follow through and in fact will sometimes reverse completely. This is defined as EE failure and is associated with a momentum increase in the opposite direction of the early entry EE. When entry is taken on a pullback, narrow range bars should be present on the retracement. A counter trend move with a momentum increase is a warning that failure is occurring. So i.e. if you see a breakout, let's say you're going long a stock through this specific level, you then get filled at the stretch using, and say the pattern was an NR7, so you get filled at the stretch of the predetermined level. You'd like to see price then power out the gate. So this is what Tony's talking about, the characteristics of EE. And then if price starts coming back, eventually it will start coming back. When price does start coming back, how does it come back? If you see a counter trend move with momentum increase, you're seeing widespread candlesticks to the downside, that is not a good sign. However, if you see narrow range bars or candlesticks and volume is declining, that would be seen as constructive behavior. So we've now got the text heavy slides pretty much out the way. It's example after example and some nice diagrams to go through. Well, it's still kind of schematics and diagrams. We'll get into some charts a little bit later on. So an inside day, Tony gives significant weight to inside days. I keep saying Tony, don't I? That's because I have a family member called Tony. Toby has or gives a significant amount of weight to inside days. An inside day is narrower than the previous day. Any narrowing day shows loss of momentum, and when within a previous stage range, it forms a congestion area. A congestion is a directionless trade with the market searching for new information. A temporary state of balance or equilibrium exists. There is a tendency for the market to trend after congestion. It appears that market participants act on the first piece of information indicating trend after the inside day, the open. Also, the direction of the close on the inside day will provide further clues on the direction of the breakout when added to the information of opening direction. The increase in percentage profit and relative profits when these variables are added supports this conclusion. So I'm sure you all know what an inside day looks like, but let me just explain. So an inside day is where the price range stays within the prior day's range. So for this instance here, example 1, we'd have the open down here. On the low of the session, it pushes up, really strong close out on the high of the session. Next session, price gaps down, the open is here, but it's still within the range of the previous day. It pushes up, another strong close, and the close is within the range of the prior day. So the whole range of this second candlestick here, or this bar, is within the range of the prior day. Here's another one where you have, it's not quite a doji, it's just kind of like it's an okay open here, and it's an okay close here, but you can see here's the low of the day, here's the high of the day up here, and then the next bar is actually trading within the entire range of the previous day. That is what an inside bar is. So price patterns, inside day, which is ID plus the narrow range 4. So now we're thinking about combining patterns. So NR4, remember, is the narrowest daily range relative to the previous 3 days' daily ranges compared individually. An inside day is narrower than the previous day. That sums up better than I was just saying on the previous chart, doesn't it? Any narrowing day shows loss of momentum when within a previous stage range. It forms a congestion area. A congestion is directionless trade with the market searching for new information. A temporary state of balance or equilibrium exist. Really important concept. There is a tendency for the market to trend after congestion. Really important concept. So from page 153 to 154, table B, which I haven't showed you table B, but table B provides more evidence that the ID/NR4 precedes trending action. In 15 of 16 tests, the ID/NR4 showed a higher probability of success on an opening range breakout than a similar opening range breakout taken on any day. This suggests that the more defined the congestion area, the better the chances of trend activity the following day. So remember, it's trends that make you money. It's really, really important. So this is why I've underlined this. This suggests that the more defined the congestion area, the better the chances of trend activity the following day. That is really, really key. This assumption that the ID/NR4 would provide a better indication of trend day activity than any of the patterns individually, just an inside bar or an NR4, also was verified. Really important. So what Toby is saying there is that combining a narrow range 4 that also is an inside day, so the ID is better statistically than just an inside day by itself and then targeting it with an ORB, or just an NR4 itself and targeting it with an ORB. So combining them actually improves the quality of the results. A high percentage 5-day pattern ending with an ID/NR4 is in an ideal entry point. I should have underlined that, probably. Let's go into some other ones. So this is where you're going to start to, if you are, let's say, a swing trader on the daily chart, these 2-bar NR and 3-bar NR, as you're going to see on the next slide as well. This is going to probably now more so represent bases and price patterns you may be more familiar with. So let's take a look. 2-bar NR is an integration of 2 vertical bars with a relative limitation in its measurement when compared to other 2-bar units. Specifically, 2-bar NR is defined as the narrowest 2-day range relative to any 2-day range within the previous 20 market days. 2-bar NR represents a condensation of the market concept called congestion or contraction. Contraction is assumed within the market principle of contraction expansion, which states that the market, having a specific nature, trader is constantly changing from a period of movement to a period of rest and back to a period of movement. This interchange between the phases of motion and rest are constantly taking place, with one phase directly responsible for the other's existence. When applying the 2-bar NR or any market concept, this bit here, really key, I should highlight it. When applying the 2-bar NR or any market concept, the full context of the market must be considered. The full context of the market must be considered. I define the market context as the integration of trend, price action, price patterns studied, and support and resistance. The primary trend The primary is the trend and overrides all other particulars of market context. Another assumption was that because this pattern exhibits a more defined contraction, that trending would take place over the next several days or so. This is really key. Table A through H tests these assumptions and confirms them. That paragraph, read it a couple of times. It's so key. It has been my observation that once the market is moved away from the open in one direction after a 2-bar NR, it should not return to the opening price. This type of price action would disqualify the day as a trend day. And you're going to learn about trend days, don't worry. Trending action is the ideal and it's expected after the pattern. So once Toby is entering a 2-bar NR or a 3-bar NR, like he's expecting the profit, the trade should show him a profit immediately, instantaneously. That is what should happen. That's also playing to win. If a new trend phase is beginning, it should be obvious and unnecessary to ask yourself if the trade was correct. You would know by the immediate profit. When the 2-bar NR has formed, it is helpful if it is holding on an important angle of support resistance. This includes trend lines. So what I really like about Toby's work is, number one, it includes Wyckoff and studied Wyckoff clearly in great depth, but also applying the market concept of, or market context and concepts of support and resistance, trend lines, thinking about moving averages, support and it's really good, I think. In fact, some of the best ORB trades occur after the market opens on an important price angle. So that could be support and resistance level, it could be bouncing off at the trend line, so on and so forth, right? The idea behind this 2-bar NR originated from Wyckoff's last point of supply or last point of support. These were described by, so Richard Wyckoff lived around about 100 years ago, by Wyckoff as periods of price action that displayed unusually narrow ranges and low volume. They occurred just after a period of accumulation or distribution and just before a market up / markdown phase. The 2-bar NR is an attempt to quantify this type of takeoff point prior to a trend. Really cool. So 3-bar NR, I'm not going to read all of this out to you as I've just read a lot to you, but basically I may read the bottom one to you down here actually, but this is basically the same as a 2-bar NR. But you see here that on a 2-bar NR, so we're just going back a slide to here, you can see that you've got the narrowest 2 range bars when you combine the range of these 2 bars relative to the prior 20 days. Whereas now, the only thing, this bar here, you see this bar that I'm hovering over, look how this changes, okay? See how it's now gone tighter? So this is then a 3-bar NR. So is defined as the narrowest 3-day range relative to any 3-day range in the previous 20 days. I will read these bottom 2 paragraphs actually. The psychological implications of a pattern of this type is interesting. This is actually a really key paragraph. In general, as the pattern is forming, speculators are absent. In fact, they tend to ignore a market that has contracted to such an extent. This is the point where the market is most ready to move and present an explosive opportunity, which is probably what you want, right? Interesting. It is ironic that so little initial interest is given to the move out of this pattern. It is well-trained traders that recognize these opportunities and provide for the force that takes the market into trend. Let me read that last sentence again. It is well-trained traders that recognize these opportunities and provide for the force that takes the market into trend. The test shows several things. One, that there is a marked tendency for the market to trend intraday the day after the pattern has formed, talking about 3-bar NRs. 2, that the overall trend of the market has an impact on the pattern's ability to continue the trend 2 to 5 days after the pattern was formed. So if this was a stock, think about the trend of the Nasdaq or the S&P. This is different from the 2-bar NR, which shows trending in the direction of the breakout regardless of the trend. 3, each market behaves differently after this pattern. You could think about this as each stock behaves differently. You'll hear me talk in other videos about the character and behavior of individual stocks. So look back at the stock's previous price history, price action. What did it do from 3-bar NRs, 2-bar NRs, an NR7 and things like that? How has it moved afterwards? The stock's behavior, I think, is the best indication of future behavior. So go back, study the stock that you're looking at. Some markets work better with a 3-bar NR, a contraction of greater duration, than with a 2-bar NR. Next slide. So price patterns, 2 and 3-bar NRs plus a little bit of context. So when applying the 2-bar NR or any market concept, I know I'm repeating this, but it's really important, the full context of the market must be considered. I define the market context as the integration of trend, price action, price patterns studied, and support and resistance. The primary is the trend and overrides all other particulars of market context. When the 2-bar NR has formed, it is helpful if it is holding on an important angle of support resistance. This includes trend lines. In fact, some of the best ORB trades occur after the market opens on an important price angle. So this is what I'm talking about here. Looking at the setups below, which do you think are better? So if we just look at the ID 2-bar NR and the ID 2-bar NRs over here, one, imagine that you're looking at both of these. Both of these are, let's just say both of them are stocks. Is stock ABC on the best, or stock ABC, is it better than XYZ, which could be the bottom one down here if you're thinking about a long? What do you think? Well, the difference is here you've got the 50-day moving average, which is starting to slope down and has acted as a resistance previously here. So is this going to be as good a setup as, say, this one here, where you've had a couple of nice shakeouts below the 50-day moving average, it then held as support, and then you're getting tightening action where price is really starting to tighten up, and you get the 2-bar NR and you get the inside day that's then holding above the 50-day moving average, indicating the longer term trend of this stock is up, whereas the top one here is indicating the longer term trend of the stock is down. Very similar with the 21-day EMA that I've shown here on the top and on the bottom as well. The bottom one for me in both instances would be a much better long setup, whereas the top one would be a much better short setup. Let's go to the next slide. So trend days. Trend days are characterized by an opening near one extreme and a close on the opposite extreme of the daily range. Trend days fall into the category of expansions. Trend days are ideal action to see on the entry day of an ORB, either long or short. So you'd like to see a trend day on the day of your entry. Whether you are going long, you'd like to see a trend day powering higher, and if you're going short, you'd like to see a trend day powering lower. So this is an example of both. So if you were to take this long setup over here, so look at this one here, see how you get this setting up really nicely. Imagine it powers through. Oh, sorry, I'm doing it the wrong way around. Imagine this bottom one down here where we're going long. So you see here how it sets up on the 21-day EMA, gets really tight, and then you see this bar here. The open is here, the close is up here. That would be a trend day. It's a widespread candlestick or bar on a relative basis. The open ideally near the low, close ideally near the high. That would be a trend day, and that's what you'd like to see after a breakout. Going short, just flip that on its head. The open would be near the high of the day, the close would be near the low of the day. It would be a widespread candlestick to the downside. This one here, let me now take you through a couple of examples. So as I said, I'm going to show you some examples from over 100 years ago. I'll take you through a couple of trades that I've done as well, where knowing this knowledge, NR4s, NR7s, the 3-bar NRs, 2-bar NRs, all of that good stuff, and then we'll go into some screening. So now I did not trade the Dow Jones on the weekly chart in 1904, as you can probably imagine, but take a look at this. Take a look back at history. How do the markets move? How do stocks move? How do cryptocurrencies move? How do commodities move? So prior, so this one here, this is a weekly 2-bar NR, tightest 2-bar range relative to the prior 20 bars, and this is on the weekly chart. Think about another Wyckoff concept is the law of cause and effect. The bigger the cause is, the bigger the effect. So if this was the 5-minute chart, you would not expect to see a cause and an effect as big as this. Whereas because this is on the weekly chart, the causality point here, the size of the base is much bigger. But this here, weekly 2-bar NR, and it's the market context. Where is it happening as well? Well, here, those of you who study, say, Minervini's work will recognize potentially a VCP. You have 1 contraction, 2 contraction, 3 contraction, and then really tight action over here. And if you would just look at this as base here, you go 1 contraction, 2 contraction, look at the tightness coming through, and then do you see how, note both of these, the 2-bar NR, note how the second bar, the final bar, tight inside bar, tight inside bar. But this one's really good because it's forming just underneath this trend line down here as well. And then look how it powers out. Now remember, we were talking about trend days or trend bars. Look at this bar here. This weekly bar here opens on the low, closes on the high. You then get another trend bar, the very next one. Opens on the low, closes on the high. Ideal action. And then let me give you a little test. What bar is this here? What pattern is this? Sorry. What pattern is that one there? Do you know? NR4. It's the tightest range within the last 4, and you could look at it, it's not quite an NR7 because I'd say that's a tighter range, but that there is an NR4. Let's do another one. Now we're on the Dow Jones again, and we are in 1915. So this one here would be an NR4 because you can see it's the tightest range within the last 4 bars. You see that? How tight this bar gets here. This is a really nice bar as well. Gap down, open on the low, push up, great sign of demand coming through. And what is the other pattern that you see forming here as well? Do you know? Be a 2-bar NR as well. These 2 bars combined are the tightest 2 bars within the last 20 bars. And where do you see it forming? Well, this here is just a really nice continuation base in the context of a powerful uptrend. So it's where are you seeing it within the context of the market or the stock or whatever financial instrument you are looking at. Dow Jones weekly chart 1925 to 1927. See over here? Now this here you get a very big, those of you who studied Minervini's work and volatility contracting, you could look at this as a big VCP, so a volatility contraction pattern that you have 1 contraction, 2 contraction, 3 contraction, 4 contractions over here. You could look at it as an ascending triangle as well, where basically you get a flat top, short price comes up above it a little bit here, but basically you get a flat top forming here and you start to get structural higher lows forming on the bottom. So structural higher lows are bullish, and then you get tightening range over here. Now we don't have the volume, but the price action is tightening. So here you have a weekly NR4 that you have the tightest bar within the last 4 weeks. You could also look at it as, is it tighter than that bar? It's pretty close, but it's certainly an NR4 coming through. So then you're starting to get the tightness, and I call these shakeout demand tails. Shakeout demand tail, shakeout demand tail. The shakeout demand tail is lessening, indicating a lessening of supply. Certainly volume is drying up as well, and it's in the context of this big base building, and it's been building higher lows. So the market context is really important as well. This one here, Dow Jones 1944 to 1945. Here you have another weekly NR4 bar. It's the tightest range bar within the last 4 weeks. Really, really tight. It's nearly, maybe you call it an NR7 as well. But you see this here, how it's building a base. This is then a downwards trend channel. You have 1 touch point here, 2 touch point here, and then this would be the break of the 3rd touch point. It's really good action to see. You could look at it as maybe a little cup and handle type pattern. This being your cup, and then this being the handle action over here. This being the main contraction of the base, so this being the potential cup, and then this being the handle over here. But see how it's forming a continuation base. So obviously having an understanding of continuation bases, I think, is important. Flags, pennants, wedges, Davis boxes, VCPs, cup and handles, all of that good stuff. This one here, Dow Jones weekly 1986 to 1987. So weekly 3-bar NR. So this is the tightest range 3 weeks within the context of the last 20 bars that you see. And see how it's just building this big base again. It's building higher lows. This black line here is the 10-week, very closely aligned with the 50-day moving average on the daily chart. And then see the tightness coming through here. You basically get a little pivot forming for around about 4 weeks or so. And then off it goes. Really good to see. So contraction, expansion, contraction, expansion. Look at the expansion in price that comes through there afterwards, but it's the context of where was the market, how was it basing, so on and so forth. So let me take you through a couple of trades that I've taken. I'll take you through some from various different years. So this is Celsius in 2020. So this one here, Celsius, clear leader. Look at the 52-week highs coming through. Search my name on TradingView and the indicators. You'll find it. I love blue dots. Relative strength line, 52-week highs is really, really good to see. Positive reaction to the earnings coming through. Big sales, all that good stuff as well, fundamentally. So see how it just pulls into its 10-day EMA here. And look how tight this bar gets here. So this is a daily NR7. Now, when you go down to the 1-hour chart, so what we're now doing is you see this really tight bar that's forming here on the daily chart. It's not quite an inside bar, but it's nearly an inside bar, so it's not an ID NR7, it's just an NR7. But you see how tight this bar is. Look how the volume dries up. If we look at that on the 1-hour chart here, this is also on the 1-hour chart an NR7. This is the tightest range bar within the context of the last 7 bars. You can actually back this out even further as well, and this would probably be like a 3-bar NR as well, and certainly a 2-bar NR if you think about it over the last 20 bars. But just what I'm showing you here, on the 1-hour chart, NR7, so fractal nature of the market, aligning multiple time frames, you will see patterns form within patterns. MP, here's another one that I took, so this is now in 2022. VCP type pattern, you get 1 contraction, 2 contraction, 3 contraction down here. You get this tight bar, nearly an inside bar, but not quite, but it's a daily NR7. It's the tightest range bar within the last 7. It's the context of a very strong stock. RS line is turning up here nicely in the context of a base. And then when we drill down onto the 1-hour chart, so we're now looking at this bar here that I call a trigger bar. So on trigger bars, I like to see, in terms of the vernacular that Toby would use, I like to see 3-bar NRs, 2-bar NRs, NR7, NR4 as well, but I really like to see tightness in price and tightness around specific moving averages that I covered a lot in recent videos. But this here, 1-hour chart, this is a 3-bar NR. These 3 bars here, this is the tightest 3-bar range that you see within the prior 20 bars on the chart. And then what pattern would you call this here? from the information that you can see at this moment in time. You'd probably call it either an NR7 or an NR4, right? And is it an inside bar? Yeah, so it would be an ID NR4 or an ID NR7, but really strong positive price action as well. Positive price action, positive price action. Gap down reversal bar here with a shakeout to Montel. Bullish synchronicity here. This is my vernacular coming through in here. Then look at the tightness and price. It's really, really good to see. So remember the principle here of contraction, expansion. Look at the contraction, look at the expansion. That one precedes the other, and they are both there for each other's existence, basically. This is 2023, this is AEHR. So does every single trade lead to an absolute massive winner? Of course it doesn't, right? So this is an NR7. So you can see it's not quite an inside bar. It's pretty darn close to being an ID NR7, but this is the tightest range bar within the last 7 days. The RS line is pretty good. It's one of the leading semiconductor stocks. Starts tightening around the 1021. So you see the tightness in price here on the daily chart, and then take a look at it on the 1 hour chart. So on the 1 hour chart, it's a 3-bar NR, but on the daily chart, it's an NR7. Makes sense how you're aligning multiple time frames here. So this is one that I took. I bought it as it came through in here. So look at the tightness coming through in the 3-bar NR. See the range of these 3 bars here, and look how the volume is just dried up below the 30-bar average being the black line. Look at the tightness here relative to what you are seeing. So aligning multiple time frames. Now this is one that I did not take. This is the last slide in the PowerPoint presentation. So the slide deck, then I'll take you into screening for these stocks that are potentially setting up these bases. But this one here, let's see, did you learn anything? Now I didn't trade this one in 2020, but I think this is an exceptional example, absolute textbook as textbook could possibly be, basically, for a 3-bar NR on a stock. Do you see where it is? Do you see the principles that are going on here? So we were looking at it on the Dow Jones from 100 years ago. You're now seeing it here as well in 2010. You'll see it in 2023. You'll see it in 2033. I don't think anything's going to change. It is literally supply and demand. Do you see where it is? So can you find the textbook 3-bar NR? And hopefully your eyes were drawn right here. So do you see the tightness and price coming through? And look how the volume dries up. So again, the principle, the core principle of contraction, expansion, contraction, expansion, expansion, contraction, expansion, contraction. Do you see how they're just interchangeable with each other? But look at this here. Look at the contraction and price. Look at the volume dries up. So another way to then think about it, if you're thinking about it from a study of force and supply and demand, the tightness and price, the contraction, the low relative volume is telling you what about supply? There ain't much supply coming through. So therefore the expansion, the stock is then very susceptible at specific levels to then expand, to see the expansion in price, which happens here. So it's really interesting, the phenomenon of contraction expansion within the market. So periods of rest into periods of motion. So I really hope you've enjoyed that. We're now going to go across to my custom stock screener, and I'll show you how you can super duper quickly find these kind of setups. This is my custom built stock screener called Stock Screen Hero. It is specifically designed to very quickly find the type of setups that I've been taking you through in this presentation. So NR4s, NR7s, 2-bar NRs, 3-bar NRs. So I'm going to show you how to do that. There is a free plan available on my website if you want to head over to it and give it a test out for yourself. So I'm going to go for one of my saved screens, which is relative strength 3 months. So I like to look for the strongest stocks within the market. I'm going to do this on US stocks, but we have other exchanges available as well. We have the India exchange, we have UK stocks, Canadian stocks, and Australian stocks as well. So currently 5 exchanges at the time of filming this. So basically I'm just looking for stocks that have a relative strength rank greater than 85, 50-day average volume greater than 100,000 shares. So what I'm going to do here is just come across, and I've already pre-done it, but I want the RS ranking to come to the top here. So I'm going to click on charts, and I'll show you how quickly you can get these kind of examples or potential chart patterns coming up. So let's just click charts here. Now I've changed layout from some of the previous videos. You can play around with this. So I've got it on a single chart per row, and the moving average here is going to be the 21 SMA. We just support simple moving averages, not EMAs at this moment in time. So I'm going to come down here, and you can quickly see how you can find stocks in powerful uptrends like PAR here pulling back into its 21. Let me go show you some specific examples I wanted to. TTI, see the tightness that comes through here? So you get really tight here, a little shake out to Montel underneath 21. That would be a really good one. So just whack that into a preset watch list or create your own watch list. Let me come back down, and I'll show you one of the setups that I was just blabbering on about in this video so far. So USM, see how it pulls back down here, and then you get a 2-bar NR, which is also an ID 2-bar NR, because the final bar coming through in there, I know I'm hovering over it, but the final bar coming through in here is actually an inside bar as well. So these are the kind of setups that you can just find really, really quickly. So as I said, there's a free plan available. Head over to my website. You'll be able to sign up and try this all out for free, basically. So thank you very much for watching the video, guys. I appreciate it, and I look forward to seeing you in a future video.